Hello, everyone. Welcome to our second webinar in our second year of partnering with UC Investments. This year, our theme is the interaction of the financial system with sustainable development goals, including climate change. I'm really delighted to have you all joining us. I'm going to introduce our moderator, and he'll introduce our speaker and title. The moderator is a very dear colleague of mine, Dan Friedman, and Dan has made seminal contributions in experimental economics, behavioral economics, and evolutionary economics, and he has also done and continues to do some very important work on financial market design. So he's just a wonderful person to have as our moderator. Over to you, Dan. Looking forward to the talk today. Thank you.
Thanks, Nirvikar. So it's my happy duty to gather all the question and answers from all the participants here and present them to our speaker. But first, let me present the speaker. I'm delighted to introduce Frederick Samama, a major player in the theme of the lecture today, the intersection of finance and environmental policy, climate. He's hosted, I think, the top conference, at least that I've heard of, on this topic, and well, I've heard wonderful things about that conference. For those of you who are economists, you will be impressed to hear that he worked with top academics, has written with top academics, including Patrick Bolton and Joe Stiglitz. Much of his career in recent years, much of the work he did in this area started at the World Bank for some years. Work on climate change and sort of the financial aspects, or how finance can help accommodate what needs to be done in that area. Currently, he's Chief Responsible Investment Officer at the appropriate unit of in the private sector at the top investment management bank. Well, I guess it's a huge part of France. I think it's one of the top 5 or 10 in the world. I hadn't heard of that's Amundi group. So that's where he's currently employed now. But I think generally he's pursuing his passion in helping the world get the financial backing that we need to deal seriously with climate change. So with no further ado, let me present Frederick, and just as we go, feel free to write in the questions and answers, any thoughts you have, and that'll be my job to pull those together and present them to Frederick. So Frederick, please take it away.
Thank you, Dan, for this very kind words. Thanks to Galina for the invitation, and I'm very glad to be with you today. I would like to share with you a striking observation on climate change. On climate change, the world woke up at the COP21 in Paris, I could say, with the commitments from governments. But beyond that, civil society entered the game. For the first time ever at the COP event, investors, corporates said, before the agreement, we are convinced and committed to do something. But then everyone went on his or her own path. You had green bonds, you had commitments from governments, and so on and so on. So it was a striking moment, but with a lot of, I would say, with multiple directions. And suddenly, over the past 6 months, we have observed the opposite trend. All players are converging on the same objective: to be carbon neutral by 2050. When I say commitments, it's about countries. Now you have 113 countries representing more than 50% of the world GDP, having such a commitment, with sometimes a legal commitment. And you have investors Net Zero Alliance, and so on and so on. And overall, they represent $100 trillion. And so when you have, on the one hand, governments representing more than 50% of the world GDP, and you have investors that one way or the other one are representing, are committed and representing $100 trillion, it's becoming the new normal. And today, I would like to speak about that. To speak about that because although this tsunami, people are still looking for how to achieve it, how to be carbon neutral by 2050. And the industry is really working very hard with many different possibilities. And today, the possibility I would like to share with you is something that I've been working on for the past 12 months, and it's a carbon budget approach, meaning a volume approach. It's very simple. It's back to science. Science says that if you want to be carbon neutral, meaning achieving 1.5 degrees Celsius increase by 2050, if you want to achieve that goal with 83% probability, then we, the planet, have a carbon budget of 300 gigatons of CO2. Carbon neutrality means 300 gigatons of CO2 with 83% probability. And then it's fascinating because we have a starting point, we have an end point, and we have a surface. And the idea we present today is to say that what is true for the planet should be true for all forms of financing. And for example, on an equity portfolio, MSCI Europe, it works for all kinds of portfolios. If you have a 25% carbon emission haircut, followed by 8% reduction, you achieve that goal. You have the same surface, starting point, end point, that's what should work for the planet. And there are two good news. There's two good news. The first one is that it has pretty limited impacts on tracking errors, from 0.08% towards 1.9%. So it should be quite easy for portfolio managers to implement. And here you have something that is very transparent, simple, scalable, and flexible. Sorry for the typo. But there's a bad news. The bad news being that the carbon budget shrinks. We actually have only 8.5 years of carbon budget. And so on the one hand, you have major amounts of money being committed. On the other hand, you have a very narrow path to achieve that. So you have a major execution risk. And to conclude my introduction, what is pretty cool is that this approach can be used as well by policymakers. They could request from investors something extremely simple, that investors should disclose their carbon pathway. What is their carbon footprint in 1 year, 3 year, 5 year, 10 year, 15 years from now? And any distance with a 1.5 degree trajectory is actually a transition risk. So policymakers could, with a snapshot, have a pretty clear idea of, for example, banks, if they're on the right track or not to achieve the carbon neutrality. So that will be the topic of my presentation today. So Dan was kind enough to refer to what I've done. I've launched very quickly. I've launched an academic center with Joe Stiglitz and Patrick Bolton 10 years ago, more than 10 years ago. We are not so many at the time, on sovereign wealth funds and how to internalize externalities. I co-launched the first coalition of investors selected by the United Nations, selected by the COP21. I've launched the first low carbon indexes, the largest green bond fund. I've testified before the US Senate. I've published numerous papers that are all available on internet. So we know the problem. We know that we are on the right, on the way to increase the emissions, and we must cut them to almost zero by 2050. It's the biggest ever challenge that humanity is facing. What we know as well is that if we fail, and we are more on the road to fail than anything else, then it means that at the end of the century, meaning for you, not for me, almost half of the planet will be in danger. Here you have a paper published in Nature about 4 years ago that makes the case that in the worst case scenario, there's a number of days above which you're in a deadly situation. And you see that you cannot live anymore in South America, Central America, part of the US, Africa, India, Indonesia, and so on, due to external temperatures and humidity. Because we, the human beings, we need to sweat to regulate our internal temperatures. And if outside it's humid, it's not working anymore.
Right. We're not seeing your slides.
You're not seeing the slides?
Right.
So I've been talking without, sorry,
Yes.
Sorry, you should have stopped me. I'm sorry. Sorry, I'm really sorry. Sorry. Should have interrupted me before. Sorry. Gosh. So I'm sorry. I'm really sorry. So very quickly, you have the introduction here, the massive shift, the carbon budget approach, the carbon budget shrinks, and policymakers could use the carbon pathway. You have the different initiatives I spoke about, like the Sovereign Wealth Fund. There's a book that refers to my profile, the Green Swan book. We'll talk about it and the fact that I testified before the US Senate. You have, I'm really sorry, you have as well the trajectory that you're familiar with. And here you have the graph about which parts of the world are in danger, meaning that 4 to 5 billion people are in danger if we are on the wrong path. Recently, about 2 years ago, 18 months ago, alongside the BIS, the Banque de France, Columbia University, I released a book that is fully available on the BIS website, the Green Swan, that said at the time that climate change is a risk that is very special because it's certain. It carries a variety of non-linear and interacting forces, physical, regulatory, and societal, meaning that it's very complicated, not to say impossible, to establish a model. And third, that is leading to extreme losses and even putting human lives at risk. And then, sorry, I'm not very good today at, and then, I think my computer is, and then it means that policymakers should change their playbooks. When human lives are at risk, you're not maximizing growth anymore. And when we published the book, obviously it was before the COVID-19, but COVID-19 is an example of a green swan. And so it says as well that climate change is a systemic risk that cannot be hedged, that goes beyond the corporate investors' way of being handled, and now is, as you certainly know, in the agenda of 95 central banks within the greening the financial system, network for the greening the financial system, as it threatens financial stability. So it's a risk, again, that is totally different from the others. And so we have to reinvent or to invent the way of handling it. Now about the main topic of my presentation, the fact that you have countries representing about 50% of the world GDP being committed on being carbon neutral. You have investors, asset owners, asset managers. I could have added banks, insurance companies, and so on. Overall, the investors that are committed to be carbon neutral are representing about $100 trillion. We could debate about the solidity of their commitments, but even if you divide by 2, by 5, by 10, it remains an incredibly big number. So the new normal around the planet is, again, to be carbon neutral. What does it mean? It means if we follow the IPCC report that was released in August this year, that with an 83% probability to achieve that goal, we, the planet, have a 300 gigaton of CO2 budget by 2050, no more. And we cannot count on natural capture systems anymore because we have already used oceans and lands more than what was required. So interestingly, I put it in a graph. We have a starting point. We have an end point that is either 0 or 10, depending on how we count it. We have a surface that has already been reduced by the amount of CO2 that we consumed last year. And you see on the bottom, we have the forest that was able to capture, but we cannot count on it anymore. And if we have some remaining emissions in 2050, because we still will have agriculture and so on, we must be able to capture it. To simplify the problem, in my presentation, we consider that we finish at 0. Starting point, end point, surface. And so what we say that what is true for the planet should be true for all forms of investments. And it says, as we see immediately, that we only have 8.5 years of carbon emissions. It's extremely short. And the problem doesn't end here, because if you estimate on which trajectory the emissions are now, although we should decrease by 95%, they are on the rise. Estimated emissions in Europe are on the rise by 65%. It's huge. So it means for investors that the likelihood that policymakers will jump in and bring the green light towards the red line is pretty high. So the sooner you start your decarbonization process, the better it is, because you will limit the risks of being impacted by policymakers accelerating the pressure on polluting companies. So you're facing the time issue and the fact that if you delay, it's becoming more risky. And so again, what we say that what is true for the planet should be translated into all forms of financing. Concretely, if we make the exercise on the MSCI Europe, but we did it on MSCI World, MSCI Emerging Markets, and so on, we can say, well, we reduced by 25% the emissions initially, not the intensity, the volume of emissions being financed through the equities, followed by 8% annual reduction over the next 29 years. And then we will have spent the 8.5 initial budget and ended at 0. Also, we have added a sector deviation constraint, meaning that we are okay to keep some energy, utilities, and so on, and we will see why later. Also, we have this constraint. The tracking error is pretty limited. It starts at 0.08%, and it goes to 1.9% in 2050, but it remains below 1% until 2040. So you see, what is true for the planet can be true for all forms of financing here on equities. And here you have the sector exposure, and you see that we have materials slightly reduced by 2%, same thing with energy, but we keep these sectors. Because at the end of the day, we want all sectors to make the efforts. So we need to give the incentives to corporates to accelerate their transition towards a low carbon economy. If we were banning them, we will not. Here we try to help the champions, the winners of each industry to be reinforced. Here you have the portfolios allocation at inception. after the 25% haircut and at maturity. And here is something that is really, I think, a pretty cool feature of this idea, is that as you will have a carbon budget year after year, you can already have a disinvestment roadmap for all the polluting sectors. Meaning that you can already say to corporates, sorry guys, I don't know, for Total, French company, in 2039, you will exit the portfolios if everything remains unchanged. Meaning that you at Total, you know the rules of the game now. And so you can decide to accelerate your transition towards a low carbon economy. And if you do better than your competitors, you will remain in the portfolios. So we are really saying to corporates, now it's up to you. We must align our portfolio with this net zero objective. If you're too carbon intensive, you will not remain, but you know if and when you will exit. And if you improve your situation, you're more than welcome to remain in the portfolios. It's exactly what we want for the planet. We want everyone to accelerate the efforts. So it's a form of very active and transparent engagement. We say to investors, to corporates, here's our disinvestment roadmap. Up to you to make it change over time. And now the very bad news. The very bad news is that if you make it in a linear way, instead of saying minus 25 followed by 8%, we make it linear, it's minus 10% per year. Problem is that in 5 years from now, this minus 10% becomes minus 18% per year. And it becomes impossible by 2029. So it means that there is absolutely not 1 minute to waste for investors to implement a net zero strategy. And now for policymakers, this idea of having a trajectory that is pretty transparent, clear, can be used to assess the transition risks. Because policymakers could easily request from banks, insurance companies, for example, all the investors that are committed to be carbon neutral, to disclose their carbon pathway. They could say, you, X and Y or Z, tell us, who are committed, tell us how you see your carbon footprint in 1 year, 3 year, 5 year, 10 years from now. And any distance with a 1.5 degree trajectory is a transition risk. And if I want to pause here for a few seconds, you see that it's very complementary to all the work done on stress testing and so on. Here we are saying the question is no more, how is my balance sheet of my portfolio to react if there's a carbon tax, if there's XYZ, if there's an impact on the world GDP and so on and so on. Here we are saying investors or the world is facing two risks: not to be fast enough. And so investors, policymakers should think about how to assess that risk. And second, the world is already committed to be carbon neutral. So if you're a bank and not being aligned with that, it's a major risk. And we can assess it very easily. It's an execution risk now. It's no more a sensitivity approach. It's how to shift your balance sheet or your investments. To conclude, for people being interested, there's a paper that describes already this talk, the content of this talk, that has been co-written with Patrick Bolton, with Marcin Kakpersik, it's complicated to say for a French guy, and is available on SSRN, so freely available. And now I really would like to conclude for you, the students. We can say that we have 3 battles on climate change. The first battle was about making the world aware of climate change. It's done. You have 95 central banks being mobilized on climate change. You have 500 investors representing $50 trillion being committed to engage with corporates under the leadership of CalPERS. You have all these commitments of investors. You don't have one single player that is not one way or the other one working on climate change. So the wake-up call has taken place, and in a pretty short period of time between COP21 6 years ago and now. But we still have 2 battles. The battle 2 is about what is ESG, what is impact investing, what are the impacts on the returns, and so on and so on. It's still slightly confusing. The academic world is working hard on it, the practitioners, so it's work in progress. But now we need to win the 3rd battle. No more about being aware, being clear, but the question remains on how to do it, knowing that we have a very short period of time in front of us. So we need to mobilize all possible brains to be innovative, to use the beauty of the financial world, where you can have financial instruments, you have you can invent, you can innovate, and so on and so on. And we need to mobilize all this energy towards inventing the financial products that will help make this planet a sustainable one. And it's part of it is in your hands. So I strongly recommend that you join whatever banks, asset managers, brokers, or whatever, and take that leadership in your hands, on your shoulders, to move the job to the next level. Thank you. And I will take questions now, if you have.
Dan, you're muted.
There, I had my unmute covered up by something, so I've got it now. Thanks. Yeah, we do have a first question, I think very good one, from Philip King, who points out that a lot of the recent increase in or heavy cyclical industries in emerging markets have been the fastest growing footprint, and now quite a large one. So how can we reduce carbon footprint globally without divesting, using these kind of divesting from emerging markets?
Well, it's not because, it's true that we had a major increase of emissions coming from India, China, and so on. It's pretty clear. At the same time, which country is the biggest investor into green technologies? Up to 2013-14, it was Europe. After that, it was China. And the US is lagging. China is implementing the largest ETS market in the world after having tested it in 7 regions. So no, we can't say okay, now the emissions are coming from emerging markets, and so we must cut it from there. The efforts have to come from everywhere, and the strategy I did show today works in EM, in the world, and in Europe. So there's no need to put the pressure only on the emerging markets.
I'll ask a question myself. I think you have an answer, but it wasn't, clear to me from the presentation. In some industries and some firms within industries have a relatively high cost, and others have a relatively low cost. Other industries have very low margin, relative marginal cost of abatement. How do you make sure that you put, how does it equalize the incentives, across these? And if they're all trying to reduce proportionately, the cost would be disproportionately on the high marginal cost of abatement industries.
We don't say that we reduce proportionally the carbon footprint of each sector. We don't reduce, let's say, by 10% the emissions of banks or whatever. What we say that at the end, the portfolio is reduced by 10%. So it will come more from utilities and so on than from banks. So we don't put the same pressure on all sectors. We just say we have a budget and we allocate it through different sectors. There's a good chance that banks will do better than the others.
So the idea is you use portfolio inclusion or exclusion or presence in the portfolio that's managed here to create incentives and pressures on companies, public companies.
Yeah, I will be back to the slide, so I have to do it properly, and then I have to, for that I need to not to do twice the same mistake. So I share my slide. You see here, I'm
sorry I didn't speak up earlier. I thought you were just giving us some speakers do that, but yeah.
Here you see that, for example, the banks are up in terms of weight in the final portfolios. So it means that, yeah, we will have more banks. At the same time, within the financial sector, we will chase the banks that have a lower carbon footprint. So really, it's about trying to identify the best players within each industry. And it's something that we almost discovered 10 years ago when we launched the first low carbon indexes. We tend to think in terms of sector homogeneity, but it's not the case. And we just have to think about the auto car makers. The situation between Toyota and Tesla and Renault on the one hand is extremely different from the situation of Volkswagen. And so what we try to figure out is which player are better positioned in terms of carbon footprint. It's not, there's no necessarily homogeneity between the players. And we could say the same thing for the within the oil industry.
Very good. I have two more questions. One from Ryan Life. He's concerned about supply chains, that you'll be able to identify, where the carbon emissions, take place along the supply chain. And sometimes it's hard to trace. So do you, how will investors view carbon emissions along company supply chain? It's
true that Well, this question of the carbon data is something I've heard for the past 10 years. So there's always, are you doing some double counting? How do you get the scope 3 downstream, and so on and so on? And then I have three levels, or I have multiple answers. The first one is the data is already very good. It's not excellent, it's already very good. And it's so good that we have already decarbonized portfolios for 10 years. And you know what? It has outperformed markets. A very basic index where you cut the emissions by 50% has outperformed in all possible regions by about 30 to 40 basis points per year, their benchmarks. The second point is to say, you're right, you could wait for 3, 5, 10 years to have the perfect data, the shift from very good to perfect. But then, by definition, all this information will be included in asset prices. So you will be comfortable, but where will be the gains? Or you start now, and maybe you will still capture some price adjustments. And by starting now, you will certainly accelerate the discovery, the price discovery mechanism. Mm-hmm. And last but not least, the graph I put here. People are saying, oh, again, how do you chase a scope 3 downstreams? I say, yeah, it's a good point. Well, true cost, others are already able to do it. So let's trust the providers. But let's keep in mind as well that here we are trying to fine-tune the data. But let's recognize that we have a lack of visibility on the big picture. I spoke about this 300 gigaton of CO2 budget. But the IPCC says at the same time, there are a lot of uncertainties. Permafrost, 100 gigaton CO2. The link between CO2 and emissions, plus minus 250, almost the budget. The non-CO2 emissions, plus minus 250 gigaton of CO2, almost the budget. So we have to accept that we have a lot of uncertainties and they won't be solved tomorrow. So we can keep on saying, oh, give me a very precise picture. The problem is it doesn't fit with reality.
Yeah. Well, actually, there's a next question was also about measurement from Peter Crampton. If I understand him correctly, he's pointing out that in electric power generation, you can get very accurate measurements, based on available data of what the footprint is, basically in real time. But that's pretty much unique. There are a lot of other industries it would be much harder to measure, for investors to measure the carbon footprint. But I take your point is that, it'll improve. There'll be now incentives to improve, and you don't wait until.
And again, all people are saying, oh, I prefer to wait for better data. Okay, but you know what? Your carbon budget shrinks. So there's a cost of time here. That is most of the time not in the debate. I will give you a comparison that is maybe slightly harsh, but I think it's the right one. If you are at the hospital and you are in the ER room, the emergency room, and you're a doctor and you have a new patient that arrives, you could say, you know what? I would prefer to have 3-4 weeks to make all possible exams and call the family and so on. No, you have to take action. It will be less precise, but by taking action now, you dramatically increase the likelihood that the patient will survive. So I think there's a totally new way of thinking that is absolutely needed among all practitioners, policymakers, and so on. The point is not about models. The point is not about precision. The point is about action.
Well taken. The question are still coming in. Michael Melvin would like to know, for ranking firms in each sector, which ESG ratings are you using at this point?
Well, at Amundi, we are using multiple ESG providers, meaning MSCI, S&P, and all the others. And we try to, we combine them, and sector per sector, we try to figure out which provider is the best one. Honestly, 10 years ago, there were a lot of discrepancies between the ESG providers. Now they are recruiting like crazy. And so the quality of the ESG data has massively increased. So it's already very excellent among the providers. So.
And then can I ask a question?
Please.
So kind of following up on Michael's question. So those indices, as far as I understand, they kind of measure the impact of firms on the environment and other ESG goals, right? To that extent, that kind of, to me, proxies for transition risk of these firms or industries, right? What if I want to measure industry exposure to physical risks, right? So an industry might be completely green, but it's still subject to, you know, floods and fires and the physical risk. Is there a measure that could be used for that?
It's a totally different exercise. That's why I only talked about transition risks. So you're absolutely right, Galina. Here, what we do is really a different exercise. We often use TrueCost as a provider that has mapped all the locations of the factories around the planet, and then figures out if that factory could be exposed to a drought, to whatever kinds of extreme weather events. And then we assess how this corporate is globally exposed to physical risks. Absolutely. But here it's a totally different exercise because it's not, it's what we do as well. But yeah, it's no more, you see, the presentation today was more about what investors can do to put pressure on corporates that are polluting. Here's the other way around, is how corporates are exposed to impacts from the nature.
Right, but as an investor, you need to be aware of both, I guess, right?
That's why
you want to create incentives, but you also want to manage your risks.
You're absolutely right. That's why usually we have 2 filters.
Okay. Thank you.
Well, let's see. Would anybody like to, anybody else among the participants like to ask a question?
There's a question from Ryan Lyle. Do investors differentiate between greenwashing efforts like buying carbon credits? I wouldn't say necessarily it's greenwashing. We could debate about it. And companies making fundamental changes to operate more sustainability. Yeah, actually, it's back to the slide here. If you see it, a couple of months ago, among some investors, there was a belief that by buying some carbon offsets, it was, or credits, it was okay to say that you're carbon neutral. I think there's a growing understanding that now you need to reduce the emissions in your portfolios. If top of it, you want to buy some carbon credits in order to offset the remaining emissions, it's fine. But you need to reduce the emissions first. So to answer the question, yes, investors are doing the difference.
There's a question from Mariana Bessa, thinking of...
Yeah, despite the fact that Europe has been investing heavily on the greener energy, the estimated emissions in Europe has been rising, as you showed. Since the investment is reducing the carbon footprint is relatively low, and there's not enough incentive for carbon reducing, what will you suggest for emerging markets? Just, I mean, who is to be impacted first? We saw it clearly, emerging markets. Where are the typhoons? Emerging markets. Where are people at risk for their lives? Emerging markets. Where is the lack of insurance coverage? You know, there is a fascinating paper that showed that the number of extreme weather events has been multiplied by 4 over the past 40 years. And then how much are the insurance companies paying back? Only a fraction. So there's an insurance gap, the part that is not covered by insurance companies. It's 56% in the US. It's 92% in Asia, 97% in Africa. So it means that when there's an extreme weather event, people are losing their homes, their assets, and so on. Is the World Bank or the IMF taking action? No. So at the end of the day, the emerging markets are the most exposed countries. And they are realizing it. If you talk to people in Hong Kong, in Singapore, and so on, they are pushing very hard because the sea level is a concrete problem for them. So, you know, they're already taking action. Is that fast enough? It's another question. And I talked about China before as well. What about bonds? It's work in progress. It shouldn't be different.
What about companies that are no longer publicly traded? You know, if I wanted to be involved and somehow be immune to the kind of pressure, if suppose this effort is successful, would it help for me to take those dirty assets private?
I don't think so, because the pressure is so big from all market participants, meaning central banks and so on, the public opinion, that it's very complicated to hide now. I wouldn't have said that 5 or 10 years ago, but now if you're a private equity firm, it's very complicated not to try to assess how your the company that you're investing in are exposed to that. And not only about the pressure of the public opinion, but again, it's back to this graph. If you're investing into a corporate now that is carbon intensive, are you at risk that policymakers will increase the pressure? The answer is yes. In Europe, we have an ETS market, like you in California, and it was not working very well. It was 4 or 5 euros per ton for years. And the world was laughing at us because we were not able to fix it. And the situation has totally changed. Just before the COVID-19, the European Commission fixed it. And you know what? The price has shifted from 4 or 5 euros per ton in a 2-year period of time towards 61.
Oh.
How many times have you heard about a tax that is multiplied by 15 in a 2-year period of time? So it's not only about the pressure of, again, the public opinion. It's the fact that the policymakers are accelerating. Is that fast enough? No. But if you're investing as a private equity firm, meaning for the next 5, 10 years, you don't want to figure out how the corporate you're investing in is exposed to that? For sure you won't.
Jagdeep has a question.
Fred, congratulations on all the outstanding work over the many years. And right now, there's so many people that are doing great work in this area. Can you give us just some names or examples of either incredible leaders that you aspire to in terms of the work they've done, or corporations that are doing exemplary work that you would guide us to say, please keep looking at what these individuals or these organizations are doing? They are at the bleeding or leading edge in the fight on climate change that you're impressed with personally.
The one that I think has been, I will not surprise you, Jagdeep. The one that I think has been the biggest game changer is Mark Carney, obviously, with his famous speech at the Lloyd's, talking about the time horizon and so on and so on. And why do I mention him as well? Because you certainly read his last book about values, and I thought that it was almost an extraordinary book for one simple reason, is that although he's a former Goldman Sachs investment banker, governor of Central Bank of Canada, of England, and so on, has been a game changer on climate change. And in his book, he says something I thought was very intriguing. He said, I'm a specialist of capital markets. I'm an economist by training. And I hear every day that we must give a price to climate change or to biodiversity. Should we? And then he refers to a philosopher that I'm sure you know about, Michael Sandel at Harvard. And in his book, Michael Sandel, for example, in the Tyranny of Merit, says, no, when we give a price to things, we change the relationship that we have with the things. And he gives a concrete example with a daycare in Israel, where parents were late, as often. And so someone at the daycare was certainly trained as an economist, said, oh, there's a negative externality, we must put a price on it, and then it will readjust to the right level, and parents will not be late anymore. Primarily that it went the other way around. Parents were even more late. And then they cut the penalty, saying, oh gosh, it doesn't work. Parents stayed late. So it opened the door. I think this book is quite interesting because it opened the door to thinking about how to mobilize human beings on climate change, and to give a price on everything is maybe not, certainly not, the best approach. The second one that I would like to refer to is Hiro Mizuno, and he's a former CIO of GPIF. There's an interesting, whoever has met with him know that he's a great person. And there's an interesting case study about him at Harvard. Hiro Mizuno said, when he was a CIO of the largest pension fund, $1.6 trillion, he said, what is my team doing? They are trying to chase returns in capital markets. As we own $1.6 trillion, the likelihood that we will outperform is pretty limited, not to say close to zero. And so even if we succeed, it's very, very little. And every 10 years, there's a financial crisis. And so we lose hundreds of years, not to say thousands of years of returns. And then he said, what is exactly my utility function? To transfer wealth to the Japanese pensioners. And do I do it with my current job? No. So instead of trying to chase little returns that will disappear over time, what about making markets more resilient for the benefit of my pensioners? And concretely, he said, I'm using a lot of passive products, public information, hundreds of billions of dollars. And suddenly he said to all the providers, how do you engage with the corporates that you own on my behalf? And many providers said, we don't engage with corporates. We are an index provider, or we are a passive manager. We don't. We just buy the shares. And they said, well, okay, fine, but you buy them on my behalf. And if you don't engage, you lose the mandates. And suddenly, one man in one country had a massive impact on the industry. I would say the third one is someone that you never heard about, but he's a hero. Is Jean Boissineau, that maybe Galina knows, who is now the secretariat of the NGFS, who passed the law, the Article 173, that was the very first law in the world that said that investors should disclose their carbon risks. It was a very smart law. It was in December 2015. It was not like, here's what investors should do, here are the norms, and investors should compare their books with the norms. He said, no, it's too new. It's still work in progress. We are still trying to assess the risks. So investors should disclose how they do it in order to create a competition between the different investors to discover the risks associated with climate change. There is something in common between these three people. They were courageous. They thought by themselves. They took action. And by putting something concrete on the table, they had a real impact on the industry. Did I answer your question?
Perfectly. Thank you. Very helpful.
Thank you. So I think we're out of time. Thank you so much, Fred, for your presentation, and Dan for moderating. On the topic of disclosure, you made a perfect segue to our next talk, which is going to be on November 5th, when Alicia Seeger from Stanford University and an advisory group on sustainable investing and disclosure is going to talk to us exactly about this topic. So please see you all back on November 5th.
And thank you to all of you. It has been a pleasure. And it's a fascinating moment now. And please, you, the students, join the efforts. And we need you. Thank you.
Thanks so much for the organizers and especially to our speaker for sharing perspectives. Thank you so much.
Thank you, everyone.